So just for understanding purpose, the kind of margin that we have in the equity futures, I am writing over here Reliance. In that, so you can see that say for the Reliance, it is say the 25th of November, 30th of December and 27th of January. These are the 3 dates for which the futures contracts are available. Lot size is what say we know, it is say 250 shares that we already have seen. You can see that say the futures price for the November is 2594. So I request you to use calculator along with me. So 2594.40 is the price of one share into 250. So that comes to 6,48,600. And you can see that so the amount of the margin is 143,623. So use your calculator, 1,43,623 upon 6,48,600 into 100, that comes to 22.14%. So you can see that say approximately say the margin that say you are required to pay when you enter into the transaction practically is near to 22.14%, 17%, 16% for November, December and January. And so this is the way, so the amount of the margin that you are required to pay when you will initiate the transaction. Of course, on daily basis, suppose you have entered into the transaction to buy and the price increases, you are fortunate enough, then the amount of the that is margin will automatically increase because the profit will be credited. And if at all there is a loss, then in that case the amount will be deducted from your amount, that is from your, that is the margin balance. And this is the way, so the calculation will be made once again on daily basis. Let us see the next question. On 2nd of August, Mr. Tandon highlight the portion sales 5 contracts of October Reliance futures at the rate of 840. Each futures contracts covers 50 shares, that is the lot size is 5050 shares. Initial margin was set at the rate of 2400 per contract. Maintenance margin was fixed at the rate of 2000 rupees per contract. Daily settlement prices are as follows, starting from 2nd to 5th. Mr. Tandon meets all margin calls. Whenever he is allowed to withdraw money from the margin account, he withdraws half the maximum amount allowed. For Mr. Tandon, you are required to calculate, first is margin call, second is the profit or loss on the futures contract, the balance in the account at the end of the each day. That is the question. I want you to prepare, so the first 3 working notes on your own. The first is the initial margin, second is the maintenance margin, and third is the profit or loss on daily basis. So now that is this time working note number 1, calculation of initial margin. That is supposed to be calculated as margin per contract into number of contracts. Margin per contract is rupees 2400 and number of contracts are 5. So that comes to an amount of rupees 12,000. That is the initial margin. Then working note number 2, calculation of maintenance margin. In that again, maintenance margin per contract into number of contracts. So in that case it is 2000 into 5, that comes to rupees 10,000. This is the way we have to start. This time the question is providing the information that the trader has entered into the transaction to sell at the rate of 6, that is 840. In the month of August, the futures contract is entered upon for the month of October. So your sale price is 840. The buy price will be 818. So difference of both of them is the profit or loss that we have. So 840 minus 818. So difference of both of them is, I think that 22 rupees is the profit per share. So 22 into lot size is 5050 into number of contracts are 5. That is the way the total profit or loss will be calculated. So 22 into 5050 into 5, that comes to rupees 5,500. Next day, the price is 866. So over here we understand that say 866 say is the revised price and the sale price will be 818. So 818 minus 866. That is the way we will compute the profit or loss. So there is a loss of 48 rupees. So loss of 48 into 5050 into 5. That comes to loss of rupees 12,000. Again, logically you can understand like this. Logically it is in this way. 840 was the price at which the transaction was entered upon to sale. The price is 866. So if at all you square off the contract at the end of the second day, then in that case there is a loss of 26. The profit which was already credited is also required to be debited. The amount of the profit which was credited earlier, 22. So the total of both of them is 48, and that is the way, say 48 rupees is the amount of the loss that you will have. Next day, the price is 830. Now the sale price is 866. So what will happen? 866 minus 830. There is a profit of 36 rupees per share. 36 into 5050 into number of contracts 5. That comes to an amount of 9,000. Then it is 846. That is the next day price. So what will happen? 830 is the sale price minus 846. So there is a loss of 16 rupees per share. Loss of 16 into 5050 into number of contracts are 5. 16 into 50 into 5. So there is in total loss of 4,000 rupees. This is a way, so the amount of the profit or loss will be calculated, say on daily basis. Heading right down. Margin statement. In that column number 1 is date. Column number 2 is particulars. Column number 3 is amount. The transaction is entered upon on 2nd of August. In that, payment of initial margin. As per the calculation that we already have made, it is 2,400 per contract into 5. That is an amount of rupees 12,000. On 2nd of August, we can see that there is a profit of rupees 5,500. So on 2nd of August, closing balance before withdrawal, it is 17,500. The question is providing the information that say whenever the trader is allowed to withdraw, he is withdrawing. So what will happen on 2nd of August? Withdrawal. It is 17,500 minus 12,000. So he is allowed to withdraw 5,500. And you can see that say he withdraws half the maximum amount allowed. So it is 5,500 into 1 by 2. That comes to 2,750. So 17,500 minus 12,000. That is 5,500 divided by 2, 2,750. So on 2nd of August, closing balance is an amount of 14,750. And so on, we are required to prepare the statement. Try to complete the remaining answer on your own. Let us see, on 2nd of August, the closing balance is 1450 after withdrawal. On 3rd of August, there is unfortunately loss of 12,000. So on 3rd of August, the closing balance is 2,750. 2,750 balance is less than the maintenance margin of 10,000. So what will happen? So this is the balance before margin call. So on 3rd of August, payment of margin. Such amount of the margin is required to be paid so that the closing balance is equal to initial margin, that is 12,000. So what will happen? It is 12,000 minus 2,750, that comes to 9,250. This is what we are required to pay as a trader. Okay. This is calculated as balancing figure. Since there is a loss, so there is no question of the withdrawal. On 4th, there is again a profit of rupees 9,000. So on 4th, balance before withdrawal it is 21,000. So on 4th, amount of withdrawal 21,000 minus 12,000, so that comes to 9,000 into 1 by 2. So it comes to 4,500. So 21,000 minus 4,500. So it is 16,500. So on 4th, this is the closing balance. On 5th, again there is a loss of 4,000. So on 5th, balance before withdrawal because we can see that the balance is still more than 12,000. So even on 5th, he will withdraw. The amount of the withdrawal will be 12,500 minus 12,000, so it is 500 into 1 by 2, that comes to 250. So on 5th of August, finally the closing balance, that is part of our answer, it is 12,250. This is the way we can compute the answer. This time we can say that, say suppose on 5th of August at the closing price you square off the transaction, then in that case 840 was the price at which you have a contract to sell, 846 is the price at which you square off the contract, so you buy the underlying asset, into 50 into 5, so 840 minus 846, 6 rupees into 50 into 5, that comes to an amount of 1500. Because basically if at all you are expecting the price of the security to further go up, then in that case of course you will be having some more amount of the loss, which you do not want. So in that case you will square off the contract, then in that case you will end up with the that is loss of 1500. So this is the point at which the question is say coming to an end. So again we have done over here, so the working notes like this. First is the calculation of the initial margin which you are required to pay when you enter into the transaction. Maintenance margin, this is the amount of the balance that say you should be having, otherwise you are required to make the payment of the margin. And then so this is importantly the margin statement. This time the question is providing the information on daily basis, if at all the balance is greater than the initial margin, he will withdraw. So whenever he is allowed to withdraw, so he will withdraw. So this is what, this is the profit or loss on daily basis. Profit or loss on daily basis, and in my opinion, so this is important. And then the simple margin statement that is required to be prepared. This time again, if at all we want to cross verify the amount of the loss, then in that case you can prepare the cash book once again. In the cash book, date, receipt, date and payment. On 2nd of August, you make the payment of the initial margin, that is an amount of rupees 12,000 to enter into the transaction. Okay, so I am showing on the payment side. On 2nd itself, you will receive an amount of rupees 2750 because that is the amount that you withdraw. On 3rd, you will make the payment of the margin call 9250. On 4th, you withdraw rupees 4500. On 4th, once again, on 5th, say you will withdraw an amount of rupees, say 250. And suppose at the closing price of the 5th, you square off the transaction. Why? Because you are expecting that say now the price will further increase and you will incur a loss. You already have entered into the transaction for sale. So if the price increases, you will incur a loss. So the payment is 12,000 plus 9250. So the total amount of the payment is 21250 minus the amount that you have received is, so minus 2750 minus 4500 minus 250 minus 12250. So you can see that the resultant value is 1500 is the loss. That is a balancing figure which we already have calculated as the difference of the two values, that is 840, that is the sale price, and 846 is the price at which you square off the transaction. Square off means you enter into the reverse of the original one. Initially you had sold it, so now you will buy it. This is what we understand.